Another thing to look at is as these are changing, we have our yield curve, our 2-10-year yield curve. And if you don't follow the yield curve, I don't blame you. Most people don't, but basically, whenever you take out a bond, you have different durations: 1 year, 5 year, 10 year, 20 year, 30 year. Typically, the longer you go out, the higher percentage return you get on your bond. So as an example, a 1 year bond might pay you 5% for 1 year. You know, a 5-year bond might pay you 7%. So you get 7% annually, but per year adds up. 10-year bond, maybe you get 10% or something. Like, the longer you lock up your money, the greater percentage return you have. That's a typical normal functioning market. If it's ever reversed and the short term is higher than the long term, then usually people in the market are scared, or they're speculative, that they don't think things are going to be good long term. So whenever you see an inversion below zero of this number, that's usually an indicator of a bad sign or recessions to come. So this, as an example, is a 210 yield curve, and this goes back to 1976. So anytime you see this low drop in here, these are volatile times. So these are from the 70s through the 80s. You see volatility here, and then you see above the zero, which is more normal rates, and then you see volatility here again. And this is the 80s, and then you see above, and then you see a low crash in the late 90s, 2000s. So this is like the dot-com bubble right here, and then it went up, and then it came down, and then you see 2007, 2008. So this is the Great Recession. I mean, the GFC, Great Financial Crisis. And then you see it go up, then you come down, and then right around here to 2019, 2020, that was the COVID pandemic. It almost flipped, but didn't. But then it came up, and then it crashed. So now we're coming back up, and whenever this spikes up, like this here, or this here, or this here, or this here, it's usually when there's been a recession in the past. So now that we're coming up out of it, we don't know if we're going to break up and smash through the zero line or not. Could happen. Right now, this is a pretty big move right here, but we're just watching to see. But if our allocation to bonds is any indicator, seeing it shoot up 2.5% in 1 week, if this keeps going up, you're going to see that bond percentage keep going up. So we're going to be making money on bonds. Now, if I'm wrong, and it maybe comes around here, doesn't quite hit, and comes back down, then our bond position will go down and we won't make money on it.